The due date for filing of personal tax returns is 31st July every year unless it is extended by the government. All individuals would be in the process of filing of tax return, and they would be in the process of collecting all the documents that is needed. Individuals whose income is more than 2.5 lakhs or 3 lakhs for senior citizens, they are mandatorily required to file the tax returns. So here are some tips for filing of tax returns which would come handy as and when you start filing your return. So first and foremost, what is important is to determine the correct residential status. Residential status is dependent on the number of days an individual spends in India in the current financial year for which the tax return is being filed, and also prior 10 years. So it is important for individuals to determine what is their correct residential status, especially if they've been outside of India or working outside of India, to determine what kind of form is applicable for them. And also there are complexities which are specific to the certain categories of residential status. For example, an individual who was on an assignment outside of India and has just come back and qualifies as an ordinary resident of India, and he's earned some salary income overseas or any other income overseas, he is required to ensure that he files the correct form and also discloses his income which he has earned overseas in his tax return. The other very important aspect is to determine which is the correct form that is applicable for the individual. So the government has notified 4 forms which are applicable for individuals. ITR 1 is typically applicable for residents whose income is less than 50 lakhs, who have salary and pension income, or income from house property, or income from other sources such as interest income. ITR 2 is applicable for individuals and Hindu undivided family having income of more than 50 lakhs, specifically if they have income around capital gains or they have assets overseas. It is also applicable for categories of individuals who qualify as not ordinary resident and non-resident. ITR 3 comes into play in case there is any professional income. In case any individual earns any consultancy income, then ITR 3 is applicable. So if you are a salaried individual and your income is less than 50 lakhs and you only have one house property and only say interest income, then ITR 1 is applicable for you. And also if you are a resident individual. ITR 2 is applicable in case you have more than one house property, you invest in stock market, you have capital gain income, then ITR 2 is applicable in your case. If you are not a salaried individual and you have consultancy income, say you are a lawyer or you are practicing chartered accountant and your TDS gets deducted under section 194J, then ITR 3 is applicable for you. For the ease of the taxpayer, the government has also enabled some pre-filled information in the tax return forms. This information typically gets picked up from your Form 26AS and the information reported either by you in the earlier years or by the other deductors of income. So it is important when you're filing your tax return using the pre-filled tax information that you check that information so that the information is accurate. So one good way of ensuring that the information which is coming in the pre-filled tax return form is correct is to match that information with, say, your Form 16 in case of salary income, your Form 16As if you have received any TDS certificate from the bank, and also from your Form 26AS, which is the statement that you download from the Traces website. And also one needs to ensure that the exempt income, say like dividend or any other exempt income, is also reported in the tax return form, which typically gets missed out by individual taxpayers. One needs to report the bank accounts in the tax return form, so it is important to ensure that the bank account details are correct, especially in case where the refunds are there in the return, so that refunds are correctly processed and are credited to the bank account. The other important aspect is to download the Form 26AS and ensure no income which is appearing in Form 26AS has been missed in the tax return. So for example, there may be some property sale and you may not have remembered that you need to report capital gains in your tax return, and there is a TDS that has been deducted which is reflecting in the Form 26AS. So that will give you a clue that this income also needs to be reported. So it is important to carefully review Form 26AS and ensure all the details are correctly captured in your tax return form. There is an increasing focus by the government to detect non-compliance. So to ensure that all the details are correctly reported in the tax return form, the return forms for this year have a lot of additional details which one needs to report, such as details of directorship, details of unlisted shares held by the individuals, details of foreign assets, which was there earlier also, the breakup of allowances and perquisites as far as salary income is concerned. So one needs to ensure that all the columns and all the details are correctly and completely filled in the tax return form, so that the return form does not become invalid. After successfully filing the income tax return on the e-filing portal of the income tax authorities, the return needs to be validated either by Aadhaar, by using the Aadhaar OTP or net banking facility. If this is not possible for any individual, then the tax return form needs to be printed, the acknowledgement needs to be printed, the acknowledgement which is ITR, and a signed acknowledgement needs to be sent to the Central Processing Center in Bangalore within 120 days of filing the income tax return online. In case the tax return is not filed within the due date, there are penal consequences. A penalty of 5,000 rupees can be levied if the income tax return is not filed up to 31st December, or 10,000 rupees of penalty in case the income tax return is filed after 31st of December. The penalty is lesser in case of people whose total income is less than 5 lakhs. The penalty in such cases only 1,000 rupees. So it is important to ensure that the income tax returns are filed within the due date so as to avoid any penal consequences.